In this video, I will talk about health savings accounts or HSAs, how they work, and the triple tax benefits of using one. I will also discuss circumstances when using an HSA may not be advantageous and how I would determine whether using an HSA is beneficial. HSA is different from an FSA. I will tell you about my FSA fiasco in a minute. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. An HSA or a health savings account is a special savings account designed to help you save money for your healthcare expenses. Because this is a tax advantaged account, you can contribute to it on a pre-tax basis and lower your taxable income. That's the first tax benefit. For 2023, if you have an individual HSA, you can contribute up to $3850 pre-tax, and for a family, you can contribute up to $7750. Let's see how this works. If I made $100,000 this year and contributed $7750 to an HSA, I would reduce my pre-tax income to $92,250. So instead of paying income tax on $100,000, I would pay tax on a reduced amount. Who doesn't like a lower tax bill? The second tax benefit is that you can invest your HSA funds, which can help them grow over time. You can invest HSA funds in various vehicles depending on what your HSA offers. Any gains or income generated in an HSA is tax-free. Fidelity has some great investment options through an HSA. I recently made this video on how you can purchase T-bills in an HSA account through Fidelity. Third tax benefit is that you can use these funds to pay for eligible medical expenses such as doctor visits, hospital stays, dental costs, etc. When you use funds for qualified medical expenses, you don't have to pay any taxes or penalties on withdrawals from your HSA account. I have linked all the qualified medical expenses in the description. So there you go. Triple tax benefits from your HSA. Here's a visual on how HSAs differ from retirement accounts. To learn about retirement accounts, watch this video. Tax-deferred retirement accounts, such as 401ks, allow you to contribute on a pre-tax basis. Any funds that you invest get to grow tax-free. However, you pay income tax when you make withdrawals. Roth accounts allow your funds to grow tax-free and your withdrawals are tax-free. However, the contributions you make are after tax. To learn about Roth IRAs, watch this video. An HSA offers triple tax benefits in that contributions made are not taxed, the growth of funds or any income generated is not taxed, and finally, the withdrawals are not taxed. While you can make tax-free withdrawals to pay medical bills, you don't necessarily have to. If you can afford to pay for qualified expenses out of pocket without touching your HSA, you can let your HSA grow tax-free. I'm sure you'll ask me, well, what's the point of the HSA? Well, you can reimburse yourself for those out-of-pocket qualified medical expenses later, even years after you've incurred them. There is no deadline for reimbursement. However, you can't reimburse yourself for expenses incurred before creating your HSA. So make sure to save all your receipts, make copies or take scans of those receipts and save them in multiple places. Letting your HSA funds stay invested until retirement allows them to grow and benefit from compounding. And while I wish you a healthy and happy life, anecdotal evidence suggests that people incur higher medical expenses as they age. Plus, healthcare costs are growing at a rate higher than ordinary inflation. Now that you know the triple tax benefits of an HSA, let's see if you're eligible to open an HSA. But before that, please show me love by hitting that like button and sharing this video with one person who may get some value out of it. And if you're new here, please consider subscribing and hitting that notification bell so you don't miss any future videos. If you watch me on Facebook, don't forget to follow my page and comment below on what you like and what you want to hear more about in my future videos. To be eligible for an HSA, you must be enrolled in a high deductible health plan or an HDHP. An HDHP is a health insurance plan with a higher deductible but a lower monthly premium, which is the next benefit of an HSA. I'll explain. Like me, if you're someone who doesn't get sick very often, this plan is perfect because I get to pay lower monthly premiums and derive tax benefits from contributing to my HSA. An HDHP typically covers preventive medical visits, such as your annual physical or a well child visit. But if you are on prescription medication or need to see a doctor more often, then an HDHP plan won't pay any medical expenses until you meet your deductible, which can be high in this case. However, there is a cap on the out-of-pocket costs you pay each year within network. So for 2023, the minimum deductible for insurance to qualify as an HDHP is $1,500 for self-coverage and $3,000 for family coverage. And the maximum out-of-pocket expense cannot exceed $7,500 for self-only coverage and $15,000 for family coverage. If you like the benefits of an HSA, the first step is to check if you're eligible to enroll in an HDHP. Most employers won't allow you to change your health insurance until open enrollment, unless there is a qualifying life event. Also, those enrolled in Medicare are not eligible to enroll in an HSA. The next step involves some math. The easiest thing to compare is whether your out-of-pocket expense will be lower or higher than the sum of the tax savings and the insurance premium differential. For example, let's say you can save $1,500 in premiums by enrolling in a high deductible health plan versus a PPO plan. And let's say you can save about $2,000 in taxes by contributing to an HSA. That's a total savings of $3,500 if you don't need to seek medical care for the year. However, all of a sudden you have to undergo surgery and incur out-of-pocket expenses above those savings. In that case, the PPO plan may be more beneficial. The third step is to ask yourself some questions, examples of which include if you have any medical conditions that will increase your medical expenses for the year, or if your preferred medical provider is in network. Some people prefer to see specific care providers that may not be covered by one plan versus the other, or if you have dependents who will need medical care over the year. With PPO, you may be eligible to enroll in an FSA plan. While many people confuse the two, FSA plans are not HSA plans. An FSA is a flexible spending account that you can use to save toward eligible medical expenses. Unlike HSAs, FSAs don't offer an investment account and often have a use it or lose it policy. I had enrolled in a low deductible PPO plan when I was pregnant and had maxed out my FSA. Fortunately, my insurance covered all medical bills throughout my pregnancy and I didn't need to spend funds from my FSA. But at year end, because of the use it or lose it policy, I had to buy hundreds of dollars worth of painkillers, antacids, band-aids, etc. from the FSA store so that I didn't lose that money. With an HSA, your funds are in some sense locked. You can withdraw from an HSA. However, if the withdrawal is for anything other than qualified medical expenses, your withdrawals will be taxed as ordinary income, and the IRS will impose a penalty. After you reach the age of 65, or if you become disabled before that age, there is no penalty for withdrawals. However, you still need to pay ordinary income tax. Watch this video next, and if you found any of this information valuable, please like this video and share it. I want more and more people to start investing in their family's future. As always, don't forget to be happy, to be kind, and to be your best self. Bye.